FTX fiasco means coming consequences for crypto in Washington, D.C. Lawmakers and pundits quickly latched onto the rapid disintegration of FTX to call for more regulation of the crypto industry. Some text goes here. The most recent news further underscores these concerns about consumer harm, and highlights why prudent regulation of cryptocurrencies is indeed needed, said White House Press Secretary Karine Jean-Pierre. Widespread consumer harm and indications of corporate impropriety only increase the likelihood that Congress will take action to regulate the crypto industry. As Congress looks toward overhauling the regulatory environment around crypto, it is important that lawmakers provide regulatory clarity without hindering positive innovation. Sam Bankman-Fried was once the golden boy of the crypto world. Launching his career in traditional proprietary trading at Jane Street, Bankman-Fried left Wall Street and founded a crypto-focused quantitative trading firm called Alameda Research in November 2017. Just over a year later, he founded FTX. One needs only read the laudatory, now deleted profile of Bankman-Fried from Sequoia Capital, which invested $214 million in FTX, to see how many believed him to be a financial savant. Bankman-Fried eventually left Alameda to focus on FTX while retaining a significant stake in the fund. FTX quickly grew to become one of the largest crypto exchanges in the world as revenues grew over 1,000% between 2020 and 2021. Faced with a liquidity crisis, FTX and Binance agreed to an acquisition. Court filings showed that the FTX group could have over 1 million creditors in these Chapter 11 cases, and legal experts have asserted that many customers may never get their money back. Following the departure of Bankman-Fried, FTX appointed John J. Over the last few years in Washington, crypto regulation has largely been considered a pre-partisan issue that cuts across political lines in ways that few issues can. It is widely acknowledged by lawmakers, regulators and the industry that crypto and blockchain technologies do not fit cleanly into existing regulatory structures, leaving much of the industry in a regulatory gray area and leading to what many have complained is regulation through enforcement. These complaints have led lawmakers to push for new legislation that aims at clarifying the rules of the road for crypto. While there are numerous smaller pieces of legislation that have been put forward, there are two major bills that seek to provide clarity for the crypto industry. The Loomis-Gillibrand Responsible Financial Innovation Act delineates the jurisdiction over digital assets between the Securities and Exchange Commission, SEC, and Commodities and Futures Trading Commission, CFTC, allow exchanges to register with the CFTC, and create new requirements for stablecoin providers, among other things. The Digital Commodities Consumer Protection Act, DCPA, would grant the CFTC exclusive jurisdiction over digital commodity trades, mandate that exchanges register with the CFTC and create new disclosure requirements for digital commodity brokers, among other things. But, lawmakers have made clear their intent to revisit this issue next year, and the collapse of FTX has only increased the likelihood of legislative action on crypto. In addition to comments from the White House and federal regulators, lawmakers have not pulled punches when it comes to FTX. Democratic Massachusetts Senator Elizabeth Warren, who has historically been critical of crypto, said the industry was mostly smoke and mirrors before calling for more regulation. The implosion of FTX must be a wake-up call for Congress and financial regulators to hold this industry and its executives accountable. Too much of the crypto industry is smoke and mirrors. Other members of Congress were more nuanced in their comments surrounding FTX. Debbie Stabenow of Michigan and John Boozman of Arizona, who are the original Senate sponsors of the DCPA, pointed to the FTX collapse as evidence for why Congress should pass their bill. The industry has also rallied around FTX to push for more regulatory clarity. The CEO of Coinbase, Brian Armstrong, penned a note the day FTX filed for bankruptcy, calling for sensible regulation of exchanges. It was already likely that Congress would take action to regulate crypto next year. As lawmakers weigh how to prevent the next FTX, it is critical that they avoid the pitfalls of panic-driven policy. As many have already pointed out, FTX's impropriety and subsequent collapse are not unique to crypto. As happened following those incidents, Congress should first investigate FTX and then produce legislation that increases transparency and closes the loopholes that allowed FTX to operate as it did. Thus far, Congress and federal regulators have been unable or unwilling to provide clear regulations for the crypto industry. As lawmakers draft and redraft legislation targeted at crypto, it is essential that any proposal be narrowly tailored to solve specific issues in a specific context. Hopefully, Congress will avoid a moral panic and will use the current momentum to produce legislation that provides regulatory clarity for crypto applications without hampering innovation.